Hello and welcome back to Intertax Learning. In international tax, every rule exists to solve a structural problem. The foreign tax credit system is one of the most important examples. It is about how countries coordinate taxing rights in a global economy. When a company earns income from outside of its home country, tax systems of these two countries often believe they have the primary right to tax it. The U.S. taxes based on residence. The sold-to country taxes based on source. When those two principles collide, you get double taxation. The foreign tax credit, or aka the FTC, is the U.S. policy solution to double taxation. If another country taxes income based on source, the U.S. will step back up to a certain limit. Every major tax system has a version of the FTC. Mastering foreign tax credit is about understanding four logics. First, the U.S. only gives credit for foreign taxes. On income, it also taxes. For example, a U.S. company has a foreign branch in Canada responsible for selling to local customers. Let's assume, in current year, the branch's revenue in Canada is $1,000 and the taxable income is $600. Canada CRA assesses corporate income tax on that $600. Meanwhile, the $600 is also assessed by the U.S. IRS. At this point, the U.S. may give credit for foreign taxes paid by the branch to Canada. The second logic is foreign tax credit cannot exceed the U.S. tax on that income. Going back to the same example, U.S. tax is 21% on that taxable income. 21% times 600 equals $126. In Canada, let's assume 15% corporate tax rate. So we're looking at $90 of tax in Canada. Since the U.S. tax amount of $126 is greater than the $90 paid to Canada, U.S. will use the $90 as the credit. Net tax in the U.S. is $36. Let's assume instead that Canada corporate tax rate is 30% instead of 15%. Now the branch pays $180 to Canada. Since that amount is greater than the U.S. tax of $126, U.S. would at most give credit of $126, which brings the net U.S. tax to zero. In other words, companies are not allowed to reduce net U.S. tax on that income below zero. The third logic is any foreign income must be categorized into one of the five baskets: general, passive, foreign branch, guilty or NCTI, and Section 901J. In our previous example, we have only one form of income. However, in real life, it's quite unrealistic to have only one form of income. When companies have so many types of different foreign incomes, this basketing process basically allows us to compare apples to apples. After bucketing all foreign incomes, we can then decide the limitation for each basket separately. Our last logic is carryover. Unused foreign tax credits can be carried over to other years. Going back to the earlier example, when tax paid to Canada is greater than U.S. tax, we inevitably incur an unusable amount of $58. We're going to keep track of this amount until it's used up in other years. In summary, foreign tax credit is how countries share taxing rights in a global economy. Once mastered this, you've learned the system. Alright, that's it for today. We went into the purpose of an FTC and its four important logics. In the next video, we'll be talking about transfer pricing. I'd like to hear your thoughts on these topics and feel free to subscribe to learn more about international tax.